Valuation versus price. What's the difference? Hi, my name is Rupali Agarwal, working at DPNC. So here's the question on what is valuation and what is price. Why do investors disagree on what a company is worth? Why does the stock price swing every day and even if nothing changes? The answer lies in one powerful distinction. Let's start with the basics. Valuation is an estimate, the intrinsic value of a business based on its fundamentals, which is the result of structured financial analysis based on cash flows, associated risks, and anticipated growth. The objective of the valuation, whether for investment, acquisition, regulatory compliance, or any strategic decision making, guides the choice of methodology. Price discovery is achieved through the application of established valuation approaches such as discounted cash flow, DCF, comparable company analysis, or asset-based valuation. Each selected methodology is based on the nature of the business and the context of the valuation. Price, on the other hand, is the actual amount someone is willing to pay or accept in the market at a given moment. Price is driven by market dynamics, supply, demand, investor sentiment, and timing. Valuation reflects what it's worth to you based on logic, forecast, and analysis. Price reflects what it's worth to others. And here's the kicker. Markets aren't always rational. Prices can be influenced by emotions, hype, fear, even herd behavior. Let's take an example. Suppose you run a startup with growing revenues and a product. Based on future cash flows and potential, your valuation is 5 million now. But investors only offer 3 million. Why? Because of market risk, lack of buyers, which is illiquidity, or negotiation power. That's the price they are willing to pay. Let's say a founder values their startup at 10 million based on user growth, projections, and market potential. But an investor only offers 6 million for a 100% stake. Valuation equals to 10 million depicts founder's belief based on business fundamentals. Price equals to 6 million, which is actual market offer based on perceived risk and negotiation power. Value is subjective. Price is the outcome of investor sentiments. Just look at the stock market. A company may be overvalued and undervalued at any point in time because price fluctuates, while intrinsic value is relatively stable and calculated. Let's take a simple example. Imagine a coffee company that's consistently profitable with steady revenue and reliable cash flows. Analysts calculate the intrinsic value at around $50 per share. Now suppose there's a viral social media trend surround coffee stocks. Excitement builds and the market drives the stock price up to $80, even though the company's fundamentals haven't been changed. That's the overvaluation, which the price is higher than the value. Later, a general market panic hits in the coffee industry. Investors sell everything and the coffee company stock drops to $35 despite no change in its actual performance. Now it's undervalued. Price is lower than the value. So in both cases, the company's intrinsic value stayed roughly the same, but the market price reacted to emotion, not fundamentals. So that's why smart investors look beyond the price tag and not focus on the value. So next time you hear a company sold for millions and ask for yourself, was that the price or was that truly the value? Because as Warren Buffett famously said, price is what you pay, the value is what you get.